Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. We have a lot of just interesting things going on in the marketplace. On Friday, we decided that we were going to do two bullish speculative trades this week. So for the first time, we're going to put two trades side by side on. And on Friday, we started by doing a skip strike butterfly in the SPX. Now, we're hoping that we're going to have 8 weeks in a row of gains in the S&P 500 index. Last week, we actually had the Dow Jones Industrial Average hit an all-time high. The markets have really taken to the fact that the Fed has said, they're okay with, well, wouldn't say okay, but the possibility of a rate cut sooner rather than later is feasible. So that has really driven the markets higher. It's driven bond yields lower. We're now seeing the 10-year below 4% for the first time in a long time. And we have the VIX index all the way down around 12.5. So not a lot of anxiousness in the marketplace. And that has turned into a positive for the markets. And we talked about this a lot on Options Guide TV, getting long going into the holidays. We've added a couple of things to our paper trading portfolio. We have some deep in the money option contracts, and last week we added Eli Lilly and Home Depot, and we haven't sold calls on them. So if I get to it, we'll look at selling some calls in that paper trading portfolio. Now, right now, I'm in the actual test account, which isn't a paper trading account, not that big of a deal, but that allows me to get quotes in the S&P 500 index, which is the SPX. We can't get index quotes inside the paper trading portfolio, mainly because they're very costly to get index quotes. So with that said, I think we're going to jump right into it because we have a lot to cover today. So if you have any questions, load them up, put them in that chat box. We want Options Guide TV to be a very interactive show. So get your questions ready and let's jump to the TradeHawk software to start. All right. So if I look at the TradeHawk software, we have the expiration for our paper trade, our speculative trade that we put together on Friday is 12/22. And so we want to make sure that we have that expiration date. We're going to check in on it. We should be down a little bit on that trade because the market is up today. When we put the trade on, and I'm going to have to zoom in here a little bit. My screenshot text is small. 47.24, and we're 47.31. So we're up just a smidge. So it should, in my mind, be trading fairly close to the net credit that we put it on for. We put it on for a net credit of 60 cents if we would have filled at the midpoint. So we have the December 22nd expiration. The first option contract that we bought is the 47.80. So we're going to scroll down to the 47.80 strike, and we're going to buy that option contract. That is the first wing of our skip strike butterfly. We're going to run up to the 47.90, and we're going to sell two of those. Click on that twice. It puts two in there. We're going to skip to 4,800, and I like that we have a nice round number right where our risk kicks in. 4,800 is at expiration. If we're beyond 4,800, that's when we start losing on this trade, or it really starts hurting us. And then we jump to the 48.10, and this is our ask, and we buy that trade. All right, so I didn't even know where the price was at. It is now at call it 45 cents at the midpoint. So we're up 15 cents on the trade. So the market, as we've said, and I'm going to toss this into the what if calculator. And we'll pull this down and we'll zoom in a little bit here. Okay. As I mentioned on the show on Friday, so I'm not going to go into too much detail. If you want more detail, please look back at the archive of last Friday's show. And I said, when you first put on the trade and you look at the what if calculator, what happens is if the marketplace goes against you hard, the green line represents your profit and loss graph. But as expiration approaches, eventually that green line starts going towards the yellow line, which is at expiration. So this morphs into that line. So our best case scenario inside a skip strike butterfly is that we slowly go up in the marketplace. That's the best case scenario. Now, if the market goes down, oh, well, we made 60 cents on our trade, right? 60 cents, our requirement would have been $1,000. That's the capital we would have had to put up. So a decent amount for 1 week's time. But our biggest concern is that huge spike up over this week, and it happens instantly. The slower the move to the upside, the better the trade is. So this is not a bad scenario at all, in that we kind of went up. We went up about 6 points since we put that trade on. Okay, so that is working. We're just going to let that run. And inside the skip strike butterfly, there's not a lot of hedging that we're going to do with the trade. If it went hard against us all the way up to this range, I don't want to. So, like, let's say we got to right here. Where is that spot? 4,800, basically. At 4,800, like I said, I would be nervous and I would probably get out of this trade. So we had 1 week. We went from Friday to Friday. If it goes all the way up beyond a 1 standard deviation move and hits this 4,800 level where I said our risk kicks in, I'm out of the trade. It's just that simple. That's the way that I'm going to manage the skip strike butterfly. I just don't want this cliff from where this is at right now all the way down to this price, right? As a matter of fact, right at our middle strike, I'm going to have an alert, and this is where I want to look at the trade. It could be profitable, it could be not. It's a very schizophrenic trade in what it wants to do. It starts out a little bearish and then becomes extremely bullish. So just an interesting dynamic. I love skip strike butterflies if I'm feeling positive in the marketplace. And obviously there's been a lot of positivity right now. Okay. Next, I told you we would do 2 speculative trades. So let's get the second one on. And as I mentioned, if you have any questions on that trade, please throw them in a chat box and I'll try to address them. Now I'm going to clear this trade out. And on this trade coming up, so the 22nd is where we want to stay. But so far in our speculation on our bullish marketplace, we have done a long call spread and we've done a skip strike butterfly. So this week, I'm like, going into the holidays, let's get a little crazy and let's stay with that. Hopefully we get one more solid bullish trade before we actually get into the Santa Claus rally. Hopefully we do get, hopefully it is a rally, but that's the period between the Christmas holiday and New Year's is usually when you see what is referenced as the Santa Claus rally. And it's just basically a lot of people allocating their portfolios, and that's usually a driver of the marketplace because you're coming to the year end. It's more so should be called the year end rally, but I guess Santa Claus rally works because it is those days. All right, I'm talking too much. Here we go. If we put this trade on, we're going to be speculative. We're going to be doubly speculative. Now, on this trade, we're going to look at the long call spread. And the long call spread, we will have an adjustment if the market goes against us. And we would actually adjust it into a butterfly. So in this instance, and the last time that we did this wasn't that long ago, I'm thinking 3 weeks ago or so, it would have a SPX in the title if you wanted to go back and look at it. When we did the trade was profitable right away. So we didn't get a chance to adjust it. Now on Options Guy TV, it's all about learning. And sometimes when trades go against us, especially in this instance with the SPX, we can look at an adjustment and learn a little bit more from the trade. But it's always good to have the market go the direction that you want it to. So let's look at this trade. And I do think it goes well with the skip strike butterfly in that if the market does run up, this trade will be profitable and it will offset some of the loss. Like let's say it skyrocketed to 4,800. Well, this trade would max out that we're going to put on, where the skip strike butterfly is going to be hurting if it happens tomorrow and we get that big jump up over one standard deviation move in that expiration that we were talking about. Okay, so when I'm setting up the trade, my whole goal in the SPX is to sell the at the money option contract and sell more time premium than I'm buying. So I'm going in the money to buy my long call, and then I'm going to sell in at the money. The in the money option contract will be worth more because it has intrinsic value, but it will have less time value. So we're at 47.36. So 47.35 will be the number that we're going to sell, the most at the money option contract. And then we're going to jump down to 10 points below that, 47.25. So here's going to be our long call spread. I'm going to buy this one and we're going to sell that one. And I'd like it to be by around $5. The market would have to come down a little bit. But here's the point. Here's where we're at. It would be really close. Well, $6. I don't mind that. I don't mind that actually. That's not bad because we're selling. We're 1 point in the money, and we're buying $19 of extrinsic value of time value, and this option contract has $23 worth of time value. It's a little bit in the money, so it's not all time premium. So if the market just stays where it's at, we would capture the difference in the time value, and this would be profitable. So even though we're paying a net debit for the trade, this is theta positive or time decay positive, however you want to say that. So if we go 10 points wide and we pay $6 for it, the maximum that we can make on the trade is then going to be $4. 10 minus 6 is 4. And the maximum we can lose on the trade is going to be the $6 that we paid for it, the premium that we paid for our long call spread. So I'll toss this one into the what if calculator as I take a little drink of water. And I'll zoom in on that. So let me zoom in where we're at right now. Now let me pull it down a little bit. And we zoom in on our trade. All right. So the underlying market is right here. This is the last trade on the SPX. And we basically, by doing this, we have two scenarios that work for us. We are already in the money on our short call option. So if the market just stays where it's at and we make it all the way till Friday, we would make the maximum on that trade, which would be $4. If the market goes up, well, that's a positive thing, obviously. And we'd want it to get all the way up to our short strike, which in this instance is 47.35. If the market goes down, to start with, it's not really going to hurt us. Well, it's going to hurt, but it's not going to hurt extremely bad. But as expiration approaches, obviously the green line, which is our profit and loss graph right now, is going to morph to the yellow line. So to start with, because there's so much time premium in S&P 500 index options, our 1-by-1 spread will, if the market goes against us, we're going to adjust it into a butterfly because there's time premium in these option contracts and it allows us to do that adjustment fairly easily. As expiration approaches, if it moves against us, that's our worst case scenario, that it just hangs out right here where it's at for almost the bulk of it. Then all of a sudden on Friday, these options are going to expire on the close on Friday. On Friday, for some reason, the market bolts down and ends up somewhere down here in this range. That would be our worst case scenario because we couldn't hedge it. We wouldn't have enough time premium to do anything about it. And we would basically be at our max loss on the trade. So when I'm putting this trade on, I'd like to do it on a Monday. I don't want to do this over the weekend like I'm willing to do a skip strike butterfly. I don't want to do that over the weekend because I don't want that huge gap that I can't trade. And Mondays have a chance, more of an possibility of a big gap down or a big gap up. That's been proven over time. So I'd like to do these on Monday, try to adjust by Wednesday if the market goes against me. Hopefully we don't have to adjust. But if the market goes against me, I will make an adjustment on Thursday. There's still enough time premium in them. Maybe we can make an adjustment based off of the market if it went against us. But if not, all we need is the market to keep going right on up. And on the upside, this green line will eventually morph towards the yellow line. So we're paying $6. So let's go back and highlight the trade. This will be the paper trade for this week, our speculative paper trade. We are buying to open the 47.25 calls in the S&P 500 index. And at the same time, oh gosh, we already moved to 47.40. 35. So this trade would it's already up. It's already at 6.30. So it's already made 30 cents. I think I would adjust the trade. Let's leave it there. Okay. So we would bet hopefully executed at $6. It keeps the math there. But okay, so let me go back and talk about the paper trade. So if I was sending this to the floor, we would be buying the December 22nd 47.25 expiration call option, and at the same time selling the 47.35 call option. Would be selling that to open. So we're buying to open, selling to open for a net debit to the account of $6. So for every 1-by-1 spread that we do, our maximum risk is going to be $600. Our maximum upside is the width of the spread, which is $10 minus 6 or $4 on the upside. And this is going to go along and enhance our skip strike butterfly portfolio. So it'll be a lot of fun to be able to come back on Wednesday and look at these trades and see how that they are playing out and make any adjustments we may need. Okay, so let's pause for a second. I know I went through that fairly fast. So once again, if you have questions, feel free and I'll try to address them. But right now I do need to do some paper trading. So I need to adjust my paper trade portfolio because on Friday's show, we didn't have enough time to sell some calls. And I didn't mind that because the market was, fairly bullish. So I didn't want to sell calls into that bullish marketplace. But normally we want to put on the option contracts and probably sell the calls within the same day. We just ran out of time. I'm trying to do everything on the show. And from time to time, that doesn't always work out. So I have to make adjustments outside of Options Guide TV on our paper trading portfolio. So what I have here, I'm going to pull up a screen grab of the paper trading portfolio, mainly because I don't want to have to log out and log back in. And let's look at the new positions that we have. Okay, so the trade that we put on last week was in Home Depot, and Home Depot is already up a good chunk, about 26%. It's trading at we're up on the one contract, and we're going to add more. We have all of our other paper trading portfolios. We have more. We're going to get to the point that we're going to have $100,000 in this paper trading portfolio at risk, and that's what our goal is. And we're going to sell calls against it all throughout 2024 and track and see how the portfolio does. And that's what the plan is. So on Home Depot, we have the 300 strike call. On Lilly, we added that, and we're down on that almost as much as we're up on Home Depot. And on Lilly, we're going to be selling some calls against it. Now, realize these are expensive underlying stocks. Part of the reason why we're buying deep into money options contract as a surrogate for the stock. Once we put this whole entire trade on, then we are going to have a fig leaf position on, or a deep into money deep into money call, and a short-term call option sold against it. And in the playbook, we call that the fig leaf. All right. So let's back out just a little bit here. And let's jump back into the software, the real-time software. So I'm not going to send this trade, but I'll send it right after the show gets done here. There we go. And we're going to look for a call option to sell in Lilly. All right, 1 second. Taking a sight, all this moving around with the StreamYard on, just going a little slower here on the software. All right. There it goes. Let's try that again. All right, we'll start with Home Depot. All right, so in Home Depot, got the market at 52. We want to go out. We don't want to go out that far in time. That's a big thing when we're selling calls on options that we own. We don't own the underlying stock. I've mentioned this many times. So we really don't want to be assigned on it if we can avoid it. So we're going to sacrifice premium by going in a little bit shorter and a little bit further out of the money, but we didn't pay as much. We didn't spend $35,000 to buy 100 shares of this underlying stock. So since we have a lot lower cost overall, then that allows us to sell a little less premium option contract. So the market's at 352.50. This is 4 days away to that expiration. We want to get a little bit more juice than that. So we're going to look at the December 29th expiration. I like that that's in between the holidays. One standard deviation move is right around the 365 level. That's a 12 delta. So this is the one that we're going to look to sell. So this would be the option contract. We're going to sell this against our deep in the money Home Depot position. It is the December 29th expiration. And I always double check, look over here inside the TradeHawk software option grid, make sure you're in that right expiration. And it highlights it up here. We're going to be selling this option contract with that expiration, the 365 strike call option. Try to get this done at, we'll call it 65 cents. So 0.65, give them a couple of cents. Try to trade somewhere close to the midpoint. And that would be our order. That will be the call option that I'm going to add to the paper trading portfolio. All right. Hopefully it's still trading there when we get off the show. All right. And then Lilly, let's go in and look at Lilly. All right. I'm having some issues. All right. We'll have to delay that one. All right. So if you have any questions, I see one here. Let's try to address it. And let's see where the markets are at. Options grid. Go back to Home Depot. All right, I have a question. At what point would you adjust it to the butterfly? Dave asks. Dave, okay, that's a good question. And actually, you're right. I didn't address that. If I put this trade on for $6, if I went to the SPX, and let's jump back to that trade. We're looking at that SPX. And we had the December 22nd expiration in the SPX. Okay. So if I'm doing this and I'm buying the 47.30 and the 47.40, and it's trading for $6 at this point in time, the butterfly trade means that we would sell another one of these. So we're going to sell one of those, and we're going to buy one of these, right? That's a short strike in this instance. 747.40, and well, we did the 35, didn't we? Okay, let me clear that out. $35.45. The market has moved with us so far. All right. And this will be a sell. 550. Okay. So this is now trading for about $5.50. We paid $6 for it. So if you think about it, if we put the butterfly on right now, if we paid $6 and it's trading for $5.50, this part, this short spread of our butterfly, that means that we would pay 50 cents to put the butterfly on right now. We're hoping that the market continues on up. So if it did continue on up, well, we're good on our long call spread. But what happens if the market goes down? If the market goes down, this loses money. So in my mind, if I paid $6 for the long call spread, if this is trading somewhere around $3, maybe $2.50, that is when I'm going to do the trade. I'm judging it 100% on what the call spread is trading at. So if we woke up tomorrow and the market was down, I'm going to say probably 20 to 30 points in the SPX, this will start trading somewhere close to the $2.50, $3 mark. Then I sell that butterfly. Okay, so this would be your alternative. You could just get out of the trade and you'd probably make more than the, let's say, $3 for our short call spread that legs us into the butterfly. Or you can put that on, let's say, Wednesday, and then you have a chip in a chair. You still have a 10-point wide butterfly, and you took half your risk off the table. You still need the market to move back up, but you didn't get out of the market, and you have a possibility that the market could come all the way back and land somewhere within the butterfly wing, which at that point in time would be 47.25. We did 35.20. Yeah, 47.25, 47.35, 47. So you got a 20-point swing that the market could land in that would also benefit your entire position. So in my mind, in that scenario, you've made one adjustment. You brought in $3. You cut your risk in half, and you have the potential in the butterfly. It's 10 points wide to maybe get out at break even. The market starts coming back, and you can actually sell the butterfly for somewhere close to $3. Well, then you're break even on the trade. So it's 100% an adjustment. And you know what? With that question, because I do really like that question, let me back out. Let's back out a little bit, and we're right at time. But let me back out a little bit, and I'm going to run to the options playbook real quick, like. And this is basically the way that the trade's going to work. We are in here, we're long calls. So right now, your long call spread, that's what we put on the trade. And then let me open up another tab, and we'll do the options playbook again. And then if we look at the next trade, which we're going to add, is going to be a short call spread. And then we'll just add one more. And lo and behold, what would we end up with? Long call with butterflies. Okay, so let's go through the progression. We put this trade on. Long call spread. Where do we want the market to go? We want the market to go up. Market goes up. Very simple trade. You just decide where you want to sell it. If you get the maximum, that means you rode it all the way to expiration. You're not going to get the maximum without getting some time decay on the strike B option contract. Market goes down. So now the market's all the way down in this range. We start, the market's right here. The market goes down this way. We then do this. Add that position. Take some of the risk of the debit spread that we put on off the table. Sell that. Guess what that happens? If you take this and this, this and this, now you have a long call with butterfly. So this is the short spread going like this. This is the long spread going like this. So I'm going to sell it. I'm going to sell that short spread when I can take about half of my risk off the table. Somewhere in that range, you can determine where you feel comfortable with. Now, also, we have the skip strike butterfly that's going with it, and that will be positive. That will be helping us out, but it won't be helping us out as much as we need, right? Because we paid $6 for the long call spread, and we only are bringing in 60 cents on the skip strike butterfly. If the market goes south, goes down. All right. That's it. Yep, that's it. That's it for this edition of Options Guy TV. Please ring the bell or click subscribe and ring the bell, and we'll see you this Wednesday at 11 o'clock Eastern time for the next edition of Options Guy TV. Thanks for coming, everyone.